Welcome to Talk Tickers. You're here for a quick take on the latest earnings calls, getting you the core info without the hours-long listen. Today, we're digging into Intuitive Surgical, the DaVinci robot company. Our mission: pull out the crucial bits for you as an investor. So, what's the big picture from their latest call?
Well, overall, it was a positive quarter for them. Operationally strong. We saw really robust growth in the number of procedures being done, system placements, selling the actual robots. That looked healthy too. And revenue saw a nice jump.
Yeah, strong performance. But you mentioned complexities.
Yeah, there's a bit of a shadow. They did have to lower their gross margin guidance for the full year. Seems like tariffs are starting to bite into profitability.
Got it. Okay, let's unpack those headline numbers first. You said procedure growth was strong.
Really strong. Globally, DaVinci procedures were up 17%. That's a significant number.
17% globally. How does that break down U.S. versus international?
Okay, so in the U.S., growth was 13%. The main driver was benign general surgery, think colon and appendix removals. Interestingly, bariatric weight loss surgery, that actually dipped slightly, mid-single digits.
Okay, 13% U.S. and outside the U.S.
Even stronger. International procedures surged 24%. We saw real strength in places like India, Korea, the UK, and their distributor markets.
Wow, 24%. What about China? That's always a big focus.
China's growth picked up too. It came in slightly above that global average of 17%, mostly urology procedures driving it there. And that international strength wasn't just one area. It was colorectal, hysterectomy, general surgery, thoracic, pretty broad.
Anything else stand out on the procedure front?
Actually, yes. The growth in procedures done after hours in the U.S. really accelerated, up 36% year over year. It kind of suggests hospitals are trying to broaden access, maybe use the machines more efficiently.
Okay, so demand for using the robots is clearly high. Are hospitals buying more of them? System placements.
They are. Placements were also up 17% compared to last year. So, yes, continued investment in the hardware.
Tell us more about those placements. What kinds of systems and where are they going?
Sure. So 367 DaVinci systems placed in total. A big chunk of that, 147, were the new DaVinci 5 systems. They also placed 19 SP single-port systems and 49 of their Ion systems for lung procedures.
And the geographical split on placements?
U.S. placements look strong, definitely helped by the launch buzz around the DaVinci 5. Internationally, it was a bit more mixed. They mentioned some pressures in markets like Germany, the UK, and Japan.
Right. So enthusiasm for DaVinci 5 is driving U.S. placements. Is that causing more trade-ins?
Absolutely. Trade-in activity really jumped in the U.S. 67 trade-ins this quarter compared to just 29 in the same quarter last year. They expect that trend to continue over multiple years as hospitals upgrade.
And how are hospitals paying?
Yeah.
Still seeing a lot of leasing.
Yeah, leasing remains popular, especially in the U.S. It accounted for 54% of placements there. And because more of the placements are the higher-priced DaVinci 5, the average selling price, or ASP, ticked up to $1.62 million.
Okay, let's focus on that DaVinci 5. It sounds like a major driver. How's the rollout going?
Seems to be progressing as expected. They mentioned over 32,000 procedures have already been done with it. They've also just installed the first fully integrated system.
Fully integrated, what does that mean?
Well, eventually it will include things like real-time surgical video review for training or collaboration, and importantly, force feedback for the surgeon. Those features still need regulatory clearance, but they're aiming for a broad launch with the latest hardware and software around mid-year. For Japan and Europe, approvals are probably closer to the end of 2025.
Force feedback. That sounds like a big deal for surgeons. What's the early buzz or data on that?
It does sound promising. Early studies are showing some positive signs, like faster recovery of bowel function in some kidney surgery patients. And in lab settings, novice surgeons using it seem to have better suturing performance, less tissue damage, fewer errors.
Interesting. So potential for better outcomes and maybe faster learning curves.
That seems to be the hope. Availability of the force feedback instruments is limited right now, but they expect that to improve significantly by the end of 2025.
And beyond the hardware, you mentioned data. Case insights.
Right. They're leveraging the data collected during surgery with the DaVinci 5. Data from over 22,000 procedures is being analyzed to help surgeons find objective ways to measure performance, look at efficiency, technique variations, that kind of thing.
So using data to improve surgery itself. Very interesting. What about their other platforms, Ion and SP?
Both showing good growth. Ion procedures for lung biopsy were up 58%. Roughly 31,000 procedures, They just got clearance in Australia and a first charge code in China, so they're pushing international expansion while also trying to grow usage in the US and lower costs.
And the SP, the single port system.
That one's really accelerating. Procedure growth hit 94%, really driven by Korea and Japan, where it's quite popular, plus early use in Europe. They also got a US clearance for a new stapler for the SP, specifically for chest and colorectal surgery, which should help adoption there. Utilization is reportedly very strong, especially in Korea and Japan.
Okay, lots of growth drivers. Let's pivot to the financials. Revenue was up 19%, you said.
That's right, 19% year over year, a solid top-line increase. If you break it down, systems revenue, selling the machines, was up 25%. And recurring revenue, that's instruments, accessories, service contracts, that was up 19%.
And that recurring piece is becoming a bigger part of the pie, isn't it?
Absolutely crucial. It now makes up 85% of their total revenue. That gives them a lot of predictability and stability in their business model.
What about the revenue they make per procedure from instruments and accessories? Did that change much?
It was actually pretty flat year over year, came in around $7,780 per procedure. Seems like there were some offsetting factors, maybe changes in the types of procedures being done, balanced by increased use of accessories for the newer SP and DaVinci 5 systems.
Okay, now let's tackle that gross margin guidance again. Came down.
Yeah, the pro forma gross margin in the quarter was 66.4%, still very healthy, obviously, but they revised the full year guidance down to a range of 65% to 66.5%.
And the main reason is tariffs.
That's the primary driver they cited for the revision. They're estimating tariffs will negatively impact the income statement by about 1.7% of revenue in 2025, and they expect that impact to actually increase each quarter through the year.
Do we know where these tariffs are coming from?
They gave some color. About half the impact is related to U.S.-China trade. Another 40% or so is from imports into the U.S. from places other than China, Mexico, or Canada. And there's an impact from tariffs on European endoscopes, too, so it's definitely something investors need to keep a close eye on.
Were there other things dragging on the gross margin besides the tariffs?
Yes, a couple of other factors mentioned. Higher facility costs, partly due to depreciation from all the new manufacturing sites they're building, and also a higher mix of revenue coming from Ion and the newer DaVinci 5. These systems tend to have lower margins initially, though they expect those margins to improve over time as they scale production.
Makes sense. What about spending? Operating expenses.
Those increased too, up 12% on a pro forma basis. Main drivers were hiring more people. Headcount was up by over 500 sequentially, with half going into manufacturing, plus those facility costs and some higher legal fees.
So costs are up, margins are under a bit of pressure from tariffs. But net income still looked pretty good.
It did. Pro forma net income was $662 million, which is 1.81 cents per share. That's a nice increase from $541 million, or $1.50 per share in the same quarter last year. So they're still growing the bottom line despite those headwinds.
And they're still investing heavily in the business.
Yeah.
CapEx.
Yes. They actually raised their capital expenditure forecast for the year, now looking at $650 million to $750 million, mostly going towards building out facilities, new sites in California, Georgia, Germany, Bulgaria, and expanding in Mexico. They're clearly planning for future growth.
Given all this, the growth, the new tech, but also the tariff and cost pressures, what's management's overall tone? Optimistic? Cautious?
I'd say cautiously optimistic about the long term. They really emphasize the size of the opportunity ahead. Their focus seems to be on building a more resilient supply chain, trying to optimize costs where they can, and sticking to their long-term investment plan. They talked about the Quinn-Tuffle aim: better outcomes, better patient experience, better care team experience, lower cost, and increased access.
How are they planning to navigate the tricky trade and tariff situation? Are they just going to raise prices?
They seem hesitant to make immediate, reflexive pricing changes. Their approach sounds more like prioritizing a global supply network, optimizing where they produce things to minimize costs, and waiting for a bit more stability before making big pricing moves. It suggests they're focused on market share and long-term relationships.
Did they flag any specific risks or headwinds we should be aware of?
A few things. Potential constraints on government capital spending in some international healthcare systems. In China, specifically, rising domestic competition and potential pricing pressure. And just the general macroeconomic uncertainty that could always impact hospital budgets for big capital purchases like robotic systems.
Okay, let's pull this all together for our listeners looking at Intuitive Surgical as an investment. What are the key takeaways from this call?
Right. Well, first, the strong procedure growth, especially internationally, and the fast fast DaVinci 5 uptake in the US really signals ongoing strong demand for robotic surgery. The fact that they raised the full-year procedure growth forecast backs that up. That's a clear positive.
Yeah, strong demand. What's the flip side?
The big one is the tariff impact on gross margins. That's definitely something you need to monitor closely. How significant will it be, and how effectively can they manage those costs? Also, the mixed international placement picture suggests some regions might be facing economic headwinds or tighter budgets, which could slow hardware sales there.
What about the technology story? DaVinci 5, Ion, SP.
The progress on DaVinci 5, especially the positive early signs from force feedback, is crucial. If that technology genuinely improves outcomes and surgeon performance, it could be a major long-term driver for upgrades and adoption. And the continued growth in Ion and SP shows they're successfully expanding beyond their traditional multi-port DaVinci system into new areas and procedures. That diversification is important.
And management strategy.
Their cautious approach to pricing amidst the trade issues suggests they're playing the long game, prioritizing market share and relationships over immediate margin protection, perhaps.
All right. That brings us to our This Is Not Financial Advices segment. Time for an outrageous but plausible trade idea based on everything we've just discussed. What have you got for us?
Okay, here's a thought, playing on that strong international growth theme. Given the momentum we're seeing in markets like India and Korea, and maybe anticipating that capital spending could eventually loosen up in places like Europe as post-pandemic funding priorities shift, consider a potential pair trade. Long Intuitive Surgical, betting on that continued global robotic adoption, particularly in these high-growth areas.
Long Intuitive. Okay. Paired with what?
Paired with a short position, perhaps in a basket of more traditional medical device companies. Specifically, ones heavily reliant on non-robotic procedures in mature Western markets, places where hospital budgets might stay tighter for longer. The idea is you're playing the theme that robotic surgery growth, especially in certain international pockets, might significantly outpace the growth of older device markets in developed economies.
Interesting. So betting on the global shift towards robotics while hedging against potential sluggishness in traditional medtech.
Exactly, but outrageous but plausible, remember. You'd absolutely need to consider currency risks, geopolitical factors, execution risk for Intuitive, and the complexities of shorting. It's definitely not straightforward.
Provocative idea indeed. Okay, that wraps up our rapid-fire analysis of the Intuitive Surgical earnings call. We've tried to cut through the noise and give you the insights that matter. What stood out most to you from this deep dive? What questions does it raise for you? Remember, this is just our take to get you started. Always continue your own research and due diligence. Join us next time on Talk Tickers for another essential earnings breakdown.
And just to reiterate, disclaimer, this is not financial advice. Any investment decisions you make should be based on your own thorough research and consideration of your individual risk tolerance.